Hi there, this is Tejas from Trendline. In this video, we look at the growth prospects for the Indian economy as global GDP growth takes a hit. We'll look at various factors, including the energy crisis that is hitting Europe's industries and consumers, as well as the high inflation and slowing economy in the US. In addition, we will look at export and import trends and where foreign institutional investors are placing their bets. At the outset, when we look at India's GDP growth of 13.5% year on year in Q1 FY23, it indicates strong economic growth. However, this growth was on a low base due to COVID-19 restrictions. In fact, India's GDP growth did not meet the consensus estimate of 15.2%, and the Reserve Bank of India's projected GDP growth of 16.2%. Though GDP growth year on year is in double digits, indicating strong economic growth, when we compare it to Q1 FY20 pre-pandemic period, real GDP growth is at a modest 3.8%. This means India's GDP has just barely surpassed the pre-pandemic GDP level in Q1 FY23. A report by Moody's mentioned that rising interest rates, uneven distribution of monsoons, and slowing global growth are expected to dampen economic momentum. Moody's cut its India's annual GDP growth prediction to 7.7% to 8.8%. Post the Q1 FY23 GDP data release, several rating agencies like Moody's and CRISIL revised down their annual GDP growth projections. Goldman Sachs also cut India's growth projection to 7% from 7.2%, and Citibank cut its projection to 6.7% from 8%. The slowing economic growth, especially in Europe and the US amid elevated inflation, is expected to weigh on India. Let's now dive into the factors that could affect the Indian economy. The energy crunch in Europe due to geopolitical crisis continues to be one of the major factors for its economic slowdown. Investment company BlackRock noted that Europe's energy crisis will send the continent into a severe recession. The soaring energy prices due to shortage is set to spike inflation even higher and weigh heavily on Europe's GDP. Before the pandemic, Europeans were buying natural gas at 10 to 15 euros per megawatt hour. Now they are paying over 200 euros per megawatt hour. Germany is particularly hit by soaring energy prices. Inflation in Germany rose 7.9% in August on the back of a staggering 35.6% increase in the energy sector. Eurozone inflation reached 9.1% in August. In response, the European Central Bank hiked interest rates by 75 basis points for the first time in history and has said that more rate hikes are coming. This could further hurt Europe's economic activity. Notably, energy spending now accounts for 11.7% of the Europe's GDP. So how will this impact India? Well, to start with, India imports around 85% of its crude requirements. Any fluctuation in crude oil prices will directly impact India's inflation and thereby its monetary policy to an extent. With Russia stopping the gas flow to Germany indefinitely via Nord Stream 1, several industries in Europe are shifting to oil. As a result, global oil demand from the gas to oil switch could jump by more than 80% over the next 6 months, according to estimates by Platts Analytics. In order to combat high oil prices, India is looking to diversify its oil imports and is considering purchasing fuel from Canada, Brazil, and Colombia amid a global rush away from gas. India's Finance Minister Nirmala Sitharaman said on September 8 that importing Russian oil was part of the country's inflation management strategy and that other nations were doing something similar. While this may cushion the rising energy prices, further energy crisis later this year could actually change the dynamics. The US economy is also struggling with high inflation and tight monetary policy. The Federal Reserve Chairman Jerome Powell has maintained his hawkish stance to combat stubbornly high inflation, which has remained well above the Fed's 2% target. Many analysts predict that the central bank will carry out additional 75 basis points rate hikes even if it slows down economic growth. US August inflation rose 8.3% in August, topping analysts' expectations despite a cool down in oil prices. In reaction, the US indices posted their biggest one-day percentage loss on September 14 since June 2020 after US CPI rose 8.3% in August. This rise in interest rate reduces the money supply in the market and could hurt Indian markets as foreign institutional investors' outflows may increase. The US dollar is also hovering around its lifetime highs against the Indian rupee with the aggressive federal fund rate hikes. However, a rising dollar could help export-focused sectors like chemicals, pharmaceuticals, and IT. In 2022, as of September 14th, FIIs have pulled out a staggering 1.46 lakh crore rupees. But there has been a monthly FII inflow into Indian equity market since July. This huge inflow in the past month, coupled with a softening in commodity prices, have helped Indian indices outperform global indices till date in 2022. The Indian benchmark index Nifty 50 outperformed most of the global market indices by a huge margin in 2022. Among Indian indices, Nifty Mid Cap 150 rose the highest at 5.9%, with the Nifty Small Cap 250 falling 1.6% in 2022 as of September 14th. Among the global indices, Nasdaq 100 is the worst it has. It has lost over 27% on the back of contracting economic growth in the US and tight monetary policy. FII is putting money into the Indian market is one of the reasons for the Nifty 50's rise. To dive deeper and analyze FII investment trends, we can look at India's exports and import data by commodity. These top 6 commodity mentioned in the slide cover over 70% of the total India's total commodity exports, and petroleum products and electronic goods exports rose over 50% in the period April 2022 to August 2022 when compared to the same period the previous year. Organic and inorganic chemicals exports also increased by 16%, representing a good demand for the chemical sector exports. However, engineering goods and pharmaceuticals only saw a modest increase. Going forward, export-focused sectors like pharma and engineering goods could be hurt by slowing export growth in these commodities. If you look at the net foreign portfolio investment, or FPI, for the past 2 months, the automobile, auto components, and chemical sectors are seeing inflows in August. In June, most sectors saw a significant outflow of FPI. With tight monetary policy in the US amid high inflation, the FPI inflow momentum could slow down going forward. However, with rising exports in chemicals, electronic goods, and petroleum products, these sectors may come out ahead and be a top choice for FIIs to invest in. Though exports rose 17%, imports rose at a higher rate of 46% in April 2022 to August 2022 compared to the same period last year. This widened the trade deficit to 125.2 billion US dollars. In August, merchandise exports fell marginally year on year by 1%, while imports rose 37%. India's Commerce Secretary BVR Subramaniam said that the rise in imports was mainly due to the jump in coal and petroleum product imports, which are being stocked up to ensure energy security. Even though import bills could decline going forward with the softening of oil prices, a fall in exports remains a concern for growth and the trade deficit. The imports bill could ease with the recent fall of crude oil prices. The crude oil price decline could be due to two main reasons. One, demand concerns due to the slowing global economy, and two, the possibility of restoring Iran's 2015 nuclear deal, which could increase the crude oil supply by over 2 million barrels per day in the long run. However, roadblocks are present here as well. The US says it is not considering additional concessions to Iran if the deal is restored. And to stop the fall in oil prices, OPEC Plus is planning to cut oil production, which could raise crude oil prices. In turn, this could light a fire under already high inflation levels across the globe. With all these moving parts at play, as if on cue, we can see India's industrial production, or IIP growth, losing steam. IIP growth saw a modest growth of 2.4% in July, missing analysts' expectations of 4.3%. India's consumer price inflation, or CPI, also rose to 7% in August after falling to a 5-month low in July. CPI print has now stayed above the central bank's upper tolerance level of 6% for the 8th straight month. Though India's economic growth looks strong now, there are several moving parts that an investor needs to look at. The energy crisis in Europe is leading to high inflation and slowing Europe's economy. And in the US, GDP contracted for the second straight quarter amid high inflation levels. This is driving tighter monetary policy, which could further dampen US economic growth and consumer demand and lead to lower exports from India. In addition, FIIs could also pull out their money from Indian markets amid tighter money supply. All these factors could play spoilsport for the Indian economy to grow effectively in a slowing world. So in this video, we looked into various macroeconomic factors that could affect the Indian economy. You can find more information about different sectors and industries on trendlyne.com. This is Tejas signing off.